Good morning, everyone, and thank you for dialing into our webinar. This is the first in a monthly series of free webinars that we will put on where the focus is to provide you with the key VAT and tax updates across the GCC. So really the aim is to give you a bit of a snapshot about what we're seeing in the market, what are significant issues, what are some recent updates from the tax authority, rather than providing any tedious technical tax analysis. So that's the focus of these webinars, and we'll be holding them on a monthly basis. Your presenters today will be myself, Mark Gamble, so I lead the tax practice in Bahrain, Raman Ori, who leads the tax practice in Saudi Arabia, and Tariq Huq, who is a manager in our VAT team. We've got a couple of panelists in the webinar today, Dao Han Hung, who's a manager in our VAT team, and Dinesh Ravi, a manager in our tax team. So they'll be around to take any questions. We want to make this webinar as interactive as possible so you get the most out of it. So please ask any questions you have in future. Come prepared with any questions you want to ask around tax and VAT. And you can ask your questions throughout the webinar in the Q&A function of Zoom. So there's a Q&A widget on your screen, either at the top or the bottom. Just click into that and ask the question. You can ask the question anonymously if you'd like, and we will we'll answer it either throughout the webinar or at the end. If we don't have time, we will still answer your question. We will just follow up after the webinar. So with that, let's get started. So we will start with Bahrain, and I'll hand over to Tariq to talk about the MBR guidelines.
Thanks, Mark. Good morning, everyone. It's a real pleasure to be here with you all today. So Bahrain's tax authority, the National Bureau for Revenue, has been fairly active recently, and they've published a few guidelines over the last few months, so there's quite a bit to talk about. In August, the NBR released two new VAT guides. Firstly, the Economic Activity Guideline, and secondly, the Transfer of Going Concern Guideline. So just briefly looking at the Economic Activity Guideline. Now, the concept of economic activity is really important to both VAT registration and input tax recovery. The guide explains how to determine whether there's any economic activity and explains the difference between passive and active holding companies. And if you're wondering whether your holding or parent company should be registered for VAT, then it's really important to read this guide. Okay, a transfer of going concern is basically a transfer of an active business, and if all the requirements are met, you may not have to pay VAT on that transfer. If you're restructuring your business or reorganizing your business or corporate structure, this guide is very relevant for you as well.
It's important to remember that this provision of a transfer of a going concern being out of scope for that can also apply if you transfer a part of your business. So say you have multiple business lines or different departments that your business works in, and you want to sell off one of those business lines, then still have a read of this guide, because it is possible to have that sale of that business line treated as out of scope for that.
Yeah. Back in June, the NBR released the Retail and Wholesale Guide, and that was extremely comprehensive and is mandatory reading for retailers and wholesalers. Now, we did prepare a brief on the guide which summarized the important issues, and that's available on our website, or you can contact one of the members of the VAT team and we can forward it to you.
Following on from the Retail and Wholesale Guide, the MBR has released an obsolete stock declaration form. So this form is relevant for those taxpayers operating in industries where old stock is regularly destroyed, or you have a new line of products coming in, so you get rid of the old line. So mainly retail and fast-moving consumer goods. So now anyone destroying goods has to submit this form to the MBR within 30 days of destroying the goods. Now, I'm raising this now because the form is actually pretty complex, and it requires information to be obtained from various parts of your organization. And it's sometimes difficult to track the info. So really have a look into the form now, because if you don't submit the form in time, you will have to pay back the input tax that you claimed when you purchased those goods or imported those goods. So it's important to have a look at that form now.
Yeah, okay. And then there was a non-resident refund scheme that's been set up recently, which allows non-resident businesses to obtain refunds of any VAT paid in Bahrain. It's actually a fairly complicated process. So if you've got any overseas sister companies that have incurred VAT in Bahrain, you should look into whether they qualify for a VAT refund. Now, the scheme is very similar to the UAE scheme. I just want to point out that Saudi Arabia has yet to finalize their scheme, and we have submitted some applications recently for clients for Saudi, but because the process has not been set out clearly yet, they're just waiting for a response from the Gazette.
And something to add there. So if you do have, say, sister companies or overseas companies incurring VAT in Bahrain, really don't wait to the last minute to look at this form, because the refund application is actually really complicated, and you need to get certain documents certified and things like that. So it will take some time. For 2020, you submit it by the end of the first quarter next year. So it sounds like this is ages away, but I know when we've looked at it for UAE and Saudi, it actually takes a long time to get the documents together. So really encourage you to have a look at it now so you can recover that VAT.
That's right, Mark. Actually, we just had a client in the UAE recently who spent 2 months trying to gather their documents, and they still weren't able to do that. So they've missed a refund now, and they'll have to wait till next year. Okay, we're moving on to public clarifications for the CBB. The NBR released a public clarification relevant for Bahrain financial institutions. You might remember for the period March 2020 up to August 2020, Bahraini nationals and businesses were not required to pay interest on certain loans, including credit advanced on credit cards. Now, the NBR has released a clarification outlining how banks should account for VAT during this period. Now, this is obviously relevant for CBB regulated entities. Essentially, the NBR has said that if a payment was due between March and August 2020, the payment due date does not trigger the VAT time of supply rules. Now, depending on how banks have accounted for VAT during this period, they will probably be required to go back and adjust their VAT returns if they made these types of loans and they were postponed.
I'll talk briefly about an update that actually happened this week for the NBR, the real estate guideline. So they've made some changes to that, but I'll just say if you have questions or that you want us to answer, please use the Q&A function rather than the raising of the hand or the chat function. We'll be monitoring the Q&A widget. So if you have questions, please use that. But back to this real estate guide. So what the NBR have done is they've said you can zero rate any services which are required to be undertaken in order to obtain a building permit from the ministry. So these are services like the original survey certificate, the layout plan certificate, engineering drawings of the plan, and construction drawings of the foundations. So those services can now be zero rated because they're related to the construction of a new building. So these rules will apply from the 1st of October. So if you're in, I guess, property development, or if you're building new construction, this is something to consider. We will cover the reviews and objections for the NBR in a case study, but briefly, there's two, and the NBR has now clarified there's two levels of, I guess, appeal. There's an internal level, which is the reviews and appeals section of the NBR. And then there's also a separate committee called the VAT Appeals Review Committee, which is separate to the NBR. So the difference between the two is the internal body, you don't have to pay a fee and you don't have to pay your VAT liability that you've been assessed. So say you were hit with a penalty for late registration, or you submitted a VAT return incorrectly and you made an amendment and you were penalized, you do not have to pay that before you appeal to the reviews and appeals section, which is good. But you need to make that appeal within 15 days of getting the assessment. The VAT Appeals Review Committee, you do actually have to pay the assessed amount before you can appeal. So if you're hit with 10,000 BD for late registration, you have to pay that before the appeals committee will actually consider your application. The application needs to be made in Arabic, and there will be an application fee, but that fee hasn't been set yet. So we'll cover this in a case study, but I guess the takeaway is try to appeal to the internal body before the appeals committee, because you won't have to pay the tax liability. So that's Bahrain for that. I will hand over to Raman now, who will talk about economic substance.
Thanks, Mark. Good morning, everyone. Just by way of a brief introduction, I lead our tax advisory function in Saudi Arabia while supporting Mark in Bahrain with non-VAT areas. As many of you would be aware that in Bahrain, the economic substance rules were introduced back last year, 2019. The purpose of these rules was primarily to target foreign multinationals and Bahraini business who do business outside of Bahrain, to prevent them from reporting their profits in Bahrain, taking advantage of the no tax regime out here without having any commercial substance. So most businesses should now be aware that if their commercial registration certificate lists one of the relevant activities for ESR, and this list was issued by the ministry in June this year, then they are required to satisfy certain conditions and are required to file an ESR report every year. The deadline for the first filing of the return was the 30th of June, which was in respect of the financial period ended 2019. We've now seen in the past couple of months, the ministry have started to issue violations for businesses who have failed to submit the return. We therefore strongly urge businesses to file their returns firstly to assess if they fall under the ESR rules, and then consequently to file the returns. They may either file it by themselves or seek some professional advice, but it's really important to take steps now, as it is highly likely that if you haven't received a violation, you will receive it over the next coming months. And then you also have the issue of the penalties. Now, within the guidelines, there's a range of anything between 1,000 dinars and 100,000 dinars, depending upon the severity of the non-compliance. However, as of now, we haven't seen the ministry applying those penalties, so it's an opportunity for all businesses to get this done as soon as possible. Back to you, Mark.
Thanks, Raman. So before we move to Saudi and UAE, we'll just talk about a couple of case studies really quickly. So for that, and this is more to illustrate how the appeal system's working. So we had a taxpayer who was penalized for late registration, hit with 10,000 BD in a penalty. So obviously a massive amount for any taxpayer. So they wrote to the MBR, requested a waiver of the penalty. After 6 months, they got a response, and the MBR has rejected their submission. So this is when we got involved. We drafted the submission to the VAT Appeals Review Committee. It was in Arabic, and we drafted a submission in English as well. It was quite a lengthy submission, and it wasn't too technical. It was more around the timeframes for VAT registration. We then attended the hearing. So you have to attend a hearing at the VAT Appeals Review Committee. Again, the submissions are in Arabic, and approximately 3 months later, the taxpayer received a credit for, it was around 80% reduction of the penalty, and that credit was processed through the VAT return. So as a takeaway, if you receive a penalty, always consider your merits for appealing. Don't just blindly pay the assessment and go on from that. Engage an advisor if you need assistance drafting the submissions and appealing before the appeals committee, and just be prepared for the appeal to take some time. Unfortunately, as we've seen in this example, it almost took a year to sort it out.
Great, excellent. Thanks, Mark. Right, so let's give you a live example of how the economic substance rules is playing out in Bahrain. So one of my clients was undertaking head office activities. It was listed under their commercial registration certificate, CR. They were required to file a return as per the rules by 30th of June, but failed to do so. Consequently, the ministry issued a violation on the CR. They approached us. We assisted them with a business impact assessment initially to ascertain if they meet the conditions for the rules, which they did. And then we also assisted them with filing of the return with the ministry over here. Finally, we then liaised with the ministry and proceeded to remove the violation. Thankfully, that was done, and we haven't heard anything back. So obviously, that's a good result for the client, and illustrates why it's now is the time to take action to make sure that you comply with the rules. Back to you, Mark.
So looking at Saudi now, the most important recent update is obviously the increase of the standard VAT rate from 5 to 15%. So this took effect on the 1st of July of this year. And since then, we've still been seeing a lot of errors being made by taxpayers, particularly around the application of the transitional rules. So the transitional rules have a couple of subsets of rules, the invoice rule and the contract rule. So we're seeing some issues with how these rules are being applied at the moment, as well as the overarching general concepts of apportioning continuous suppliers. So there are still some issues at the moment. And this will probably be the case until 30 June of next year when the transition period ends. Gazette has also updated their VAT return format. So if you're submitting VAT returns in Saudi, you would have seen there's an option to select that you make both 5% and 15% supplies or purchases. And there are additional fields now that you need to complete. So make sure your system can separate the two types of transactions so you can report things correctly.
Yeah, and another update is the Gazette amnesty. I'm sure everyone has heard about this a number of times, so we won't spend too much time on it. Now, in essence, you have until 30 September, so that's just over 2 weeks away, to disclose any errors and pay any outstanding tax liabilities. Now, it's a really good initiative, and we've seen many clients benefit from having penalties waived, but time is really running out. So please just make this a top priority if you haven't taken advantage of the amnesty yet. Now, as part of the amnesty, the Gazette has extended the deadline for submitting VAT returns and paying. This comes to the end of this month. This comes to an end at the end of this month. So if you're using this extension, the May 2020 VAT return and the August 2020 VAT return is due at the end of this month.
One thing we continue to see with the Gazette is their focus on VAT compliance. So the Saudi media and the Gazette are constantly publishing articles about the number of inspections that they've undertaken and the amount of mistakes that they've found. So there is clearly a focus for that at the moment. At the moment, it seems to be mostly compliance errors and simple errors like reporting your VAT as inclusive, your prices as inclusive of VAT and things like that. But there is an indication that the Gazette is following up with taxpayers. The Gazette has also updated their tax ruling request guideline. The guideline itself hasn't changed a great deal, but they have introduced a new form that should be used to apply for private rulings. So if you want to get your position confirmed by the tax authority, you submit it through a private ruling application. So there's a new form. Make sure you use this new form because your application will be rejected immediately if you're using the old form. They're being very strict on this, so definitely use the new form. Raman, do you have anything?
Yeah, sure. Thanks, Mark. There's been a few tax updates over the past 2 or 3 months. Firstly, with regards to capital gains. Now, capital gains is the profit on the sale of shares or assets, which is taxable at 20%. There was a circular released by the Gazette stating that the sale of shares which were originally purchased from the subscriber is not subject to capital gain. And also a couple of other transactions which are exempted are when the sale of when there's been a transfer of the shares or assets from one group entity to another. Again, when there's no cash being exchanged. And so the gain would relies only upon the subsequent sale of the shares to a third party outside of the group, and obviously where there is some cash consideration. The second update was that the Gazette have updated their online portal, the IRAT system, whereby Saudi taxpayers can now file contract information forms. These forms are mandatory if you enter into a contract over 100,000 Saudi Riyal per month. Some of the features include entering the required information if you enter into a new contract, provide any updates or any amendments to the contract, and finally, when the contract comes to an end or has been cancelled for whatever reason, you are required to notify the Gazette. Only one of the parties is required to upload this information on the IRAT system. The Gazette would automatically contact the other party to verify the information given. If you are in an oil and hydrocarbon business, investing in resident listed companies, any gains will not be subject to corporate tax, but to Saudi zakat. One of the recent updates in international tax law was the publication of the MAP guidance. Now, just to give you a bit of background, Saudi Arabia has signed up to an international initiative aimed at targeting multinational enterprises who legally transfer profits from high to low tax jurisdiction, therefore obviously pay low tax. So one of the requirements was for Saudi to introduce this measure, and it's really aimed at a taxpayer who can approach the MAP committee, who will look at any disputes which have not been resolved at the local level, so at domestic tax authority level. Examples being transfer pricing adjustments, any permanent establishment issues, or in order to avoid double taxation. And finally, the last point. Now, the amnesty talks about penalty waivers if a taxpayer would voluntarily come forward and disclose errors. But what happens if the Gazette actually issues an assessment first? So this is another example of what we did for a client, a Saudi client. So the client received an assessment of 8 million Saudi Riyal for the year 2018. Additional tax payable was 6 million, along with penalties of 2 million. So total assessed amount was 8 million. We helped the client to file an objection against the assessment. However, based upon the required documentation, the client was in a position to only object against 50%. So 50% of the assessment was accepted, and therefore the client was due to pay an additional tax of 3 million, which they did. We then subsequently had discussions with the Gazette, and we were able to successfully argue that since the client acknowledged the mistakes in their returns and paid the tax within the amnesty period, that is before the 30th of September, the penalties should be waived. And they agreed with that. So a great result for the client in the sense that they have managed to save 1 million in penalties. So I guess the key takeaway here is that if you're in a similar position, you have just over 2 weeks from now. So please, if you are looking to settle, now is the time to approach your Gazette relationship manager. You probably, it would be better if it is done through your professional advisors, or you can seek advice, but there is that option available where you can settle the due liability, rightfully payable, and save on the penalties.
So looking now at UAE, so the Federal Tax Authority, the FTA, has been fairly active over the last few months for VAT, starting with the e-commerce guideline. So this guide is relevant for businesses that import and export goods or services over the internet to and from the UAE. So it's so wholesalers, retailers should be looking at this guide. For those in Bahrain and Saudi, it's still relevant for you if you're purchasing goods or services from a supplier based in the UAE. or to a customer there. It covers some pretty complicated issues for cross-border sale of goods, like when the title to the goods transfers. That's relevant for ascertaining import VAT, as well as the place of supply. And it also covers the use and enjoyment rules for electronically supplied services. So there's a fair bit in that guidance worth having a read. Tarek?
So for zero-rated exported services in July this year, the FTA clarified the zero rating rules on exported services. Now, and that was following a change to the regulations there. In order to zero rate the supply of services, the recipient must be outside the UAE when the services are performed. Now, under the new rules, a recipient is only considered outside the UAE if they have a short-term presence in the UAE of less than 1 month. Okay, and also the presence must not be connected with the actual supply. Now, under the old rules, it was actually easier to meet the zero rating criteria. So if you're a supplier selling services from the UAE, or you're outside the UAE buying services from a supplier within the UAE, then what you should do is consider whether your transaction can still be classified as zero rated. Okay. You should also read the change of law in line with the FTA's clarification, as it does provide some guidance as to how to determine a customer's residency status and when a recipient is considered to be outside the UAE at the time of supply. Okay, and then there's also something about the change in use of real estate. The FTA released a public clarification on the VAT treatment of sales of real estate. Now, where the purchaser changes the nature and use of the building following the purchase, for example, a residential building sold and later converted to a hotel by the purchaser, the clarification goes on to say and confirms that the VAT treatment is assessed at the time of each supply. So just because the purchaser later changes the use of the building, it doesn't change the character of the building at the time it was purchased.
Okay, and finally, just talking about the economic substance as it applies to the UAE. So similar to Bahrain, it was introduced last year in 2019. Eligible licensees are legal persons or unincorporated partnership businesses who undertake relevant activities. Last month, the Ministry of Finance have announced a number of changes to the regulations, namely exempting a number of businesses such as investment funds, individuals, licensees who are resident outside of the UAE, or UAE branches of overseas businesses that declare the income from the branch in their foreign tax return, or businesses who do undertake relevant activity but did not earn any income in 2019. Licensees are probably well aware that they were required to file a notification by the 30th of June 2020. However, in light of these changes, they're now required to reassess if they still fall within the rules. And if they do, they need to refile the notification, letting the FTA know that they comply with the rules. Now, the format for the notification has not been released. We understand that will be released pretty soon. In terms of the report filing itself, the first filing for the year 2019 will be the due date will be the 31st of December 2020. In terms of the administration of the regulations in the UAE, we have two bodies. One is the FTA, which is the, slipped my mind here, Federal Tax Authority. Yeah, Federal Tax Authority, who will be tasked with assessing if businesses are subject to the rules and to ensure compliance with them. The Ministry of Finance will be the overarching authority responsible for sharing information with the overseas tax jurisdiction if their resident is not compliant with the rules in the UAE. And finally, just a point on the penalties. The guidelines have given a range between 20,000 dirhams to 400,000 dirhams based on the severity of the compliance, but we don't know how this will be implemented, as obviously the first filing isn't due till the 31st of December.
Great, thanks, Raman. So just quickly on the other GCC countries. So Oman, the draft VAT law is currently with His Highness the Sultan for review. It passed through the State Council and Shura Council last week or the week before. So we should be hearing something soon. So in the coming days and weeks. Earlier in the year, it was announced that the VAT in Oman will be implemented in the first half of next year, but now the media seems to be reporting it's going to be 2022. But ultimately, I think we just need to wait and see at the moment. Kuwait, there's nothing new in tax or VAT. Qatar, if you're operating in Qatar, you need to apply for the online tax portal, the Deriva portal, by the end of this month. So make sure you look into that. Otherwise, nothing to share on tax and VAT in Qatar. So that concludes the formal presentation part of the webinar. I've been trying to monitor the questions throughout, and I think Dawhan and Dinesh have tried to answer a couple of the questions. I will just try and open up now, and we'll just go through a couple. So is the VAT rate likely to triple in Bahrain like it did in Saudi? I mean, who knows, right? It's just one of those things where they might announce it overnight or they might not. So at the moment, there's no sign that they will. What else? So we've got a question on the transitional rules in Saudi. So there's a vendor who charges me periodic bill for car rentals, but contract is signed before the 11th of May. Should it have been 5 or 15%? So this question is getting at the transitional rules that apply in Saudi, given the VAT rate change. So if you want to apply the contract rule, you need to meet certain requirements, including the contract needs to be signed before the 11th of May, so the date when the rate increase was announced. The contract needs to be between two parties that are VAT registered, and the customer needs to be entitled to recover VAT in full on that supply. So if those circumstances are met, it should still be 5% up until the earlier of the contract ending, it being renewed, or 30 June next year. So if it sounds like you've probably got a continuous supply, so you should have a look at the continuous supply rules as well. But if you can apply the contract rule, that's the best rule. Otherwise, you have an invoice rule, which says if I've issued an invoice before the 11th of May, then that can remain at 5%, providing the services or the goods are delivered before 30 June of next year. So there's a couple of rules working there. What else we got? So we've got a holding company question. So there's a holding company in Bahrain that only earns dividend income. Does it need to register for VAT? Does it need to register for economic substance? So for that, Tariq, what do you reckon?
Well, it depends again on the facts of the case probably there, but generally speaking, if they're only earning dividend income, so you have a shareholding in one company and all you get is a dividend annually or biannually, then it's unlikely you're doing economic activity and you probably won't be required to register. But having said that, if you've got a big portfolio and you have holdings in many companies, then you probably want to consider again.
Yeah, so just before we go to economic substance, that new guide on economic activity, have a read of that, because it distinguishes between a passive holding company and an active holding company. And I mean, in the market, I think it's fairly common that there's quite a few holding companies set up. So you really need to see, is my holding company actually doing anything? Is it running a business? Is it carrying on an economic activity? Or is it merely just passively receiving dividends? From economic substance?
Yeah, from an economic substance perspective, yes, you would be required to comply with the rules, because holding company activities is a relevant activity for the purposes of economic substance. You would be required to undertake an impact assessment so as to make sure that you meet certain conditions, and you will also be required to file an ESR report every year.
Question around, can you share the business impact assessment for economic substance regulations?
Good question. Unfortunately, there isn't a template as such. The business impact assessment is something which is tailored based upon the nature of activity and the conditions that need to be met based upon the activities undertaken. So if I understand this correctly, you require some clarifications on the economic substance rules and the obligations. So please feel free to reach out to me, and I will see how we can assist you with that.
So we had a question around, if I buy something in Saudi, how do I get the VAT back? Does it make any difference if it's personal or business use? So if you incur VAT in another jurisdiction where you're not based, then generally the only way to recover that is to have a VAT registration in that country. So that's the starting point. Some jurisdictions have mechanisms set up to refund VAT from other jurisdictions. So like the one we were talking about with Bahrain having now a policy for non-residents to recover VAT. So there is systems. Saudi doesn't really have a set system at the moment. It's in the law, so you can technically apply, but there's no set practical position at the moment, unfortunately. Question around the submission of the first Bahrain ESR return was via email only to the ministry. Do we have any update that the ministry have updated the Sigilat portal to submit the next return, or is it still not updated?
Not yet. At the moment, we are still submitting returns by email to the ministry. We understand from that the portal will be updated in due course, but we're waiting for that to happen.
Thanks, Raman. We had a question around capital assets and recovery of capital assets. So, Tarek, do you want to talk through capital asset rules?
Yeah, that's fine. So when you purchase a capital asset, either you will know what you're going to use it for, or you have an intention that you're going to use it to make certain types of supplies. So where you're intending to make taxable supplies only from the capital asset purchase, then usually you can recover the input tax in full upfront. So you don't capitalize the VAT over a number of years. However, if you incur a capital asset cost and you're going to make exempt supplies from that supply, then generally you will not be able to recover any VAT at all. So I'll give you an example. Say you purchase a building and you're going to rent the building out, which is exempt from VAT. You probably won't be able to recover the VAT on that. However, if you buy a building, the same building, and you're going to operate a hotel, which is, you'll be making taxable supplies, then in that case, you'll probably be able to recover the input tax in full. That's obviously subject to the normal input tax recovery criteria as well.
Yeah, thanks, Tarek. So what you should do though, is when you buy a capital asset, and you should set up a new kind of register or a list of all your assets, you assess the input tax recovery position at the time of purchase, and you claim the VAT on that basis. So say you bought a car and it's going to be used only for taxable activities, then recover all the VAT right there. Then depending on the value, you need to assess, or depending on the value and type of asset, you need to then keep a record on a yearly basis to assess whether your activity has changed. So say you're using the car in year one to do taxable activities, and then you start making exempt supplies, and that car is used to make a portion of exempt supplies, then you need to go back and adjust that initial recovery.
That's right. And just to sort of say about the adjustment, for when you purchase a capital asset and you recover the input tax in full, that's not end of the story, like Mark said. Every year thereafter, you need to consider whether you continue to make only taxable supplies. And if you make non-taxable supplies, then you'll probably have to pay a portion of that input tax back.
Question now on, can I recover VAT on employee medical insurance? And this is one that it just continues to crop up. So the MBR's view on this is, if the business is required pursuant to any law in Bahrain or Saudi to provide this medical insurance to the employee, then you can recover the VAT on the insurance, on the premium. But I guess the confusion often arises is when you have different categories of insurance. So you might offer something that is like a really high quality insurance that covers, I don't know, every hospital or the increased coverage or something like that. So to the extent that it's more than what is required under the labour law, our view is that you shouldn't recover the VAT on the extent that's beyond that, because it's not provided in the labour law. So I'd only recover VAT to the extent it's provided in the labour law.
Yeah, sorry, just a quick point on that, Mark. A lot of questions crop up about the family insurance as well. Now, the family insurance, what you should do is check the labor law of Bahrain. And if you have a requirement to provide that insurance, then you can recover the VAT. But remember that you need to make sure you stay updated, because the law may change suddenly, and then you should obviously, adjust input tax based on that.
Yeah. So another interesting question: real estate services, so maintenance services provided by a Saudi company in Bahrain, is it vatable if billed to a Saudi company of that particular customer, since the contract is between Saudi companies only? Okay, so it's kind of got two parts there. So if I'm a Saudi company providing maintenance services in relation to a property that's based in Bahrain, you need to first work out where your place of supply is for that purposes. So because this service sounds like it's related to real estate, then generally the special place of supply rule that says services related to real estate take place where the real estate is located. So if the real estate's in Bahrain, your place of supply is Bahrain. Now, if you're supplying to a customer that is VAT registered, then they will most likely apply the reverse charge on that transaction. So the Saudi company might not have to register for VAT in Bahrain. Now, if your supplier and your customer are both Saudi-based, but the property's in Bahrain, then there's a strong risk that the Saudi supplier will have a VAT registration requirement in Bahrain, because the place of supply is Bahrain and the customer is not registered for Bahraini VAT because they're in Saudi. So good question, a bit complicated. If you need help with it, obviously reach out. Question: any possibility to recover VAT incurred in UAE by a company based in Bahrain? For instance, we arranged a labor service for a client in UAE and the provider charged VAT as the service was used in the UAE itself. So this, I suspect, we'll see happen a lot more now, because the UAE has changed their rules to zero rate supplies of services. Tariq, I know you've recently done an application for a refund. Is it easy? Or?
No, it's a very difficult process, because a lot of companies will have, they'll require registration documents. I think the documents have to be in Arabic or English, and if they're not, then they'll have to be translated, attested. You have to go through the court sometimes. You have to get the stamps done. I would say minimum of 3 months. I would leave myself if you want to apply for a refund. That's what I would say.
And I think from memory, there's a limit to the value that you can apply for. So I think once it reaches, it's something like 5,000 dirhams or something like that. There's a threshold?
Yeah, there's a minimum threshold. I think it's about 200 BD equivalent, I think. And if it's less than that, then you can't make an application. Obviously, if it's less than that, it wouldn't be worthwhile making an application anyway. So you do need to assess how much it's going to cost you to make the application, because you might incur a lot of costs in trying to get that input tax back.
Question now around supplying lifts to a new building. So third party do the installation of the lifts. We do the electrical and commissioning. Can we raise an invoice with the zero rate? So this is going to the rules around services related to construction of a new building. And it's really important you read that real estate guide, because it sets out in detail the types of services that will qualify for the zero rate. This feels like something that should be zero rated, but I'd have to look at the guide to confirm. But I'm happy to do that if you send us an email to just, I guess, vat@keypoint.com, or even to me directly, and we'll answer your question. We're running out of time. We've got 2 minutes left. As we said, we will answer all these questions and send around the answered questions to everyone anyway. So I guess if you have questions, feel free to ask them, and we can always answer via email. I'll just pick out a couple. So appealing to the VAT Appeals Review Committee, does it need to be in Arabic? What happens if we can't speak Arabic? So what you can do, and yes, it does need to be in Arabic, but you can also submit an English application. We do know of taxpayers submitting it wholly in English, but the requirements do say it needs to be in Arabic. You can take a VAT consultant along with you to the appeal to present the submissions in Arabic, but there's just mechanisms around that to make sure that they'll be able to speak on your behalf, but you can do it. If I've got assessed for a penalty and the 15 days has passed, what do I do if I want to object to it? So you have that 15-day window to apply it internally to the appeals and review section. If you miss that deadline, you still have 30 days to appeal to the VAT Appeals Review Committee. But again, that requires you to pay the liability and the associated fee. That's time, and I don't want to go over because I want to keep these we want to keep these seminars really short and sharp and just trying to cover the key points and issues that arise. If you have questions, always feel free to reach out to us. We will definitely send around the slides as well as the answers to the questions, and please come prepared next webinar, which will be next month, with your questions ready to go, and we'll answer them. We can answer them then. But that's it from us. Thank you for joining, and I hope you got a lot out of it.
Thank you.
Thanks.